Okay, let's just dive right into this. Welcome everyone to a brand new explainer. I'm Ibrahim, and look, if you've been following our journey so far, you already know we're going deep into the architecture of the market here. We're stripping away all that surface level noise to see the actual underlying code. So today, we're bringing you a really high energy, deeply quantitative briefing. We are going to look at the sovereign printing press of this entire ecosystem. Basically, we're decoding the stablecoin matrix. So let's get right to it. Welcome back to the Neuro Finance Masterclass. Today, on day 102, we look at the ultimate fuel of crypto liquidity. You know, you're not here to just gamble. You are here to build a structural, highly strategic understanding. And today's lesson, well, it's the absolute foundation of market movement. So think about yesterday, day 101. We mapped out exactly how capital rotates between Bitcoin and altcoins using the dominance index. And yeah, that was a fantastic lesson on flow. But today, we need to completely reframe the board. I need you to ask yourself a much more fundamental, honestly much more revealing question. Where does the raw fuel for these massive crypto pumps actually come from? I mean, think about traditional finance for a second. When those markets need a boost, what happens? Central banks literally turn on the printing press and inject fiat currency to create liquidity, right? But in our decentralized universe, who plays the role of the central bank? Where is that massive injection coming from? Well, here is our tactical briefing for today. We're covering 1, the fuel of crypto, 2, Kuru Barut, which is dry powder, 3, the Stablecoin Supply Ratio, 4, the divergence play, and finally, number 5, your very own liquidity audit. All right, section 1, the fuel of crypto. It's time to completely ignore the hype. If you want to operate like an elite architect in this space, you absolutely have to tune out the social media hype and look directly at the engine room. And that engine room, it's powered by the Stablecoin Matrix. Primarily, we're talking about USDT, USDC, and DAI. Now, these assets, they perform the exact same function as traditional fiat injections do in the crypto ecosystem. They're cryptocurrencies pegged to a stable asset, usually the US dollar. They are the bridge, literally the mechanism through which outside capital enters our arena. I'm telling you, understanding the flow of these 3 specific assets is like seeing the future of the market before it even happens. Moving on to section 2, dry powder, or as we also call it, Kuru Barut. Okay, so we need a total paradigm shift right here. Most retail investors out there, they view stablecoins as just safe havens, right? A comfy place to hide when the market gets a little scary. But I need you to stop seeing them that way right now. Let's think back to our lesson on day 42. Remember we defined Kuru Barut, dry powder? This is fiat money that is already sitting inside the crypto ecosystem. Yes, it is de-risked capital, but far more importantly, it is ammunition resting directly on the battlefield. When big institutional investors or really smart retail traders want to de-risk, they don't bother going all the way back to their traditional bank accounts. That takes way too long. They park their capital right there in stablecoins. They're just waiting. They are preparing to buy. So the absolutely crucial point here is this. A rising total stablecoin supply is a massive structural bullish indicator. Why is that? Well, because when the aggregate supply of all stablecoins expands, it literally means fresh, new fiat currency is entering the crypto ecosystem from the outside world. It's not just the same old capital moving from room to room inside the house. It's brand new capital walking right through the front door, looking for a place to sit. It is without a doubt the ultimate leading indicator of purchasing power. Which brings us to section 3, SSR, the Stablecoin Supply Ratio. The math on this one is incredibly simple, but what it reveals is just profound. The SSR is calculated simply by dividing the Bitcoin market cap by the total stablecoin market cap. Boom, that's it. But what this little formula actually measures is the exact balance of power between Bitcoin and the digital dollars just waiting on the sidelines to buy it. And this brilliantly illustrates the 2 main states of the market. On one side, you've got a low SSR. We like to call this the coiled spring. A low SSR means the total supply of stablecoins is incredibly high relative to Bitcoin's market cap. All those available dollars have immense buying power. That spring is coiled so tight, and even a tiny rotation from those stablecoins into Bitcoin can trigger a massive explosive upward pump. But then, on the other side, you have a high SSR, the exhaustion zone. This means Bitcoin's market cap has completely outgrown the stablecoin supply sitting on the sidelines. The market is literally running out of cash fuel. When you see this happen, you know for sure the rally is likely hitting a local exhaustion point. Next up, section 4, the divergence play. This is all about smart money tactics.
Now, this is where we transition from simply observing the board to really understanding how smart money manipulates it. An elite architect always tracks the divergence between price and stablecoin flows. And listen, if there is one single thing you write down today, please make it this. The price drop is artificial, the liquidity buildup is real. When you can spot this divergence happening, you are literally watching smart money loading their clips in plain sight on the blockchain, exactly like we discussed back on day 92.
So here is exactly what that divergence indicator looks like in the wild. Bitcoin's price is dropping, or maybe it's just moving sideways in this boring, choppy range. But simultaneously, the total supply of USDT and USDC is aggressively expanding. The printing press is running blazing hot while the price looks totally weak. Guys, this is a trap for retail, but it's a massive signal for you. Do not fall for the artificial panic. Absolutely do not panic sell. Instead, you prepare your DCA machine. Remember our day 69 protocols? You align your dollar cost averaging with that incoming capital deployment, because I promise you, that coiled spring is about to snap.
All right, Section 5, your liquidity audit. Time for your cognitive task.
It is time for your final tactical directive. Look, we don't just want you to sit there and listen. We want you to execute. So here is your literal checklist to rule the cycle yourself. Step 1, open up your on-chain data platform, whether that's Glassnode, CryptoQuant, whatever market tracker you prefer to use. Step 2, look up the total market cap charts, specifically for USD and USDC, over the last 6 months. And step 3, audit the fuel. Observe if the total stablecoin printing press is expanding, shrinking, or just stagnating. By doing this, you are actually calculating the purchasing power of the entire market.
You really have to train your mind to view these stablecoins not as some boring safe haven, but as the underlying tidal force that commands every single asset in your portfolio. So I'm going to leave you with this provocative question to ponder today. Are you tracking the surface-level noise of Twitter and random price wicks, or are you tracking the foundational fuel that actually moves the machine? Master the Stablecoin Matrix, audit the fuel, and you will rule the cycle. That's it for today. We'll see you tomorrow for day 103. Keep building that neurofitness.